Hey everyone, welcome back to Corporate Decoder. Today, FCFS just filed a current report on Form 8 talking about a revised offer for another company, and I'm seeing a big potential increase in value. Quick note, this is not financial advice, just my take on public filings for educational purposes. This update signals a potentially sweeter deal for shareholders, but there are definitely some key conditions to watch. Alright, so FirstCash Holdings Incorporated, or FCFS as you might know them, they've put out a document that basically updates us on a deal they're working on. It is an acquisition, meaning they plan to buy another company. This time, it is a company called Ramsdens Holdings PLC, which is based over in the United Kingdom. Now, this isn't the first time we've heard about this potential deal. Back on the 23rd of June, they announced an initial offer, but things have changed, and on the 16th of July, they announced a revised offer. Think of it like getting a new and improved proposal. The big news here is that the price has gone up. Previously, the shareholders of Ramsdens were offered 609 pence per share. That was made up of 600 pence in cash from FirstCash's subsidiary, Bidco, and a small dividend of 9 pence. The new offer, however, bumps that up to 684 pence per share. So that is an extra 75 pence per share coming from Bidco, plus that same 9 pence dividend. This is a pretty significant increase. When you add all that up, FirstCash is now looking to pay about 229 million British pounds for Ramsdens. This is an increase of about 26 million pounds compared to their first offer. For FirstCash shareholders, this means they are potentially acquiring the company at a higher price, but it also suggests that Ramsdens might be a more attractive target at this higher valuation. And perhaps the initial offer was seen as too low by Ramsdens owners. The way they plan to do this deal is through something called a scheme of arrangement under UK law. This is basically a legal process to get approval from the Ramsdens shareholders to sell their shares. It is a common way to handle acquisitions in the UK. Now, this deal isn't a done deal yet. There are still some important hurdles they need to clear. First, the Ramsdens shareholders themselves need to vote and approve this revised offer. It is not just a simple majority, they need a majority in terms of the number of people voting, and those votes must represent at least 75% of the total value of the shares. Then, the High Court in England and Wales also needs to give its okay. On top of that, they need to get approvals from regulatory bodies in the UK, like the Financial Conduct Authority and the Competition and Markets Authority. These are important checks to make sure the deal is fair and doesn't harm competition. And finally, all of this needs to happen before the end of December 2026. If all these conditions are met, they expect the deal to be finished sometime in the latter half of 2026. So while the offer is higher and potentially better for Ramsdens shareholders, there are still quite a few steps before FirstCash officially owns them. It is also important to note that this document itself isn't an official offer to buy shares. It is more of an announcement about the offer. They make it clear that any decision to sell should be based on the official scheme document, which will contain all the full details. They also point out that because this is a UK company being acquired through a scheme of arrangement, the rules are different from what we're used to in the United States. For example, the financial information might be prepared using UK accounting standards, which may not be directly comparable to US standards. This is something investors should keep in mind. It also means that US tender offer and proxy solicitation rules won't apply here in the same way. And for any US shareholders of Ramsdens, they are really pushing investors to talk to their tax advisors because receiving cash for their shares will likely be a taxable event. This is pretty standard advice for cross-border transactions. They also mention that under UK rules, Bidco might buy shares outside of this official offer before the deal closes. This is a common practice to ensure market stability or to acquire shares from those who can't participate in the main offer. They clarified these purchases would happen at market prices or negotiated prices and would be disclosed as required. Like most of these filings, this report is loaded with forward-looking statements. These are basically educated guesses about what might happen in the future regarding the deal, the benefits, how it will be paid for, and the outlook for both companies. They use a lot of cautious language like expects, may, could, and anticipates, and they are very clear that these forward-looking statements are not guarantees. They come with risks and uncertainties. Things might not turn out exactly as planned, and they spell out some of those potential issues. The biggest risk, they say, is that the deal might not happen at all. This could be because they don't get shareholder approval, or regulatory bodies don't give the green light. They also mention that if approvals are delayed or come with conditions, it could reduce the expected benefits of the acquisition. Then there are execution risks. What if they can't successfully combine the two companies? What if the expected savings or benefits take much longer to achieve than they think? And what about management's time being diverted from running the current business to focus on this big acquisition? These are all real concerns in any merger. They also touch on things like keeping key employees at Ramsdens, various tax-related issues, and potential costs associated with compliance. A very specific risk mention relates to how they are financing this deal. They talk about drawing down on their existing credit facilities and a bridge credit agreement. This suggests that how they manage their debt and funding for this acquisition is a crucial piece of the puzzle. If their financing plans hit a snag, it could jeopardize the whole deal. They also mentioned that a copy of this announcement will be posted on FirstCash's investor relations website. This is standard practice to make sure information is widely available. And for those who prefer paper, they provide instructions on how to request a hard copy of the announcement. This is part of the UK's regulatory code to ensure accessibility. They even mention you can request all future documents in hard copy form. Finally, at the very end, you see the signatures. R. Douglas Orr, who is the Executive Vice President and Chief Financial Officer, has signed off on this report, confirming that, to the best of his knowledge, the information presented is accurate. This is essentially the sign-off that makes the filing official. Now, let's put this all together. FirstCash Holdings, FCFS, is clearly looking to expand its reach by acquiring Ramsdens Holdings PLC, a UK-based company. The revised deal brings a significant increase in the offer price, suggesting a stronger commitment and potentially a more attractive target than initially perceived. We're talking about an extra £26 million, which is a big chunk of change. However, this isn't a certainty. The deal hinges on a number of UK-specific approvals, from Ramsdens' own shareholders and the High Court, as well as regulatory bodies. The financing aspect, with mentions of a credit facility and a bridge loan, is another area that investors should keep a close eye on. The biggest risk, as they candidly state, is that the acquisition might not happen at all. This is a common outcome for deals that require multiple approvals. But if it does go through, the integration of Ramsdens into FirstCash's operations will be crucial. The market likes FCFs. With a market cap of around $9.4 billion and a P/E ratio of about 26.8, suggesting investors see growth potential. Institutional investors like BlackRock and FMRLC hold substantial stakes, showing confidence from large players. What I am watching closely here is how effectively FirstCash manages the integration and realizes those expected benefits. The increased offer price could also impact the immediate financial hit to FirstCash, though the promise of synergy and expanded market share is likely the driver. It is a classic case of a company looking to grow through acquisition by buying a competitor. And the success will ultimately be in the execution and the achievement of promised returns. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please give it a like, subscribe for more, and join our Discord community linked below.